Welcome to this week's episode of Jonathan on Money. This is episode number 121. Before we get started today, I'd like to share with you just a small win I had a few days ago. I went to the beach the other day, and after the beach, we got ice cream because that's my personal min hug. Anyway, I got vanilla ice cream with half the topping being toasted coconut flakes and the other half being chocolate munchies. That's what they're called. I'm not 100% sure what they are. And this sparked immense joy in my life. Now, the lesson here is simple. It's actually twofold. One, always stay diversified with your portfolio and ice cream toppings. And the second thing is it's the small things in life that truly generate the most happiness. They're not necessarily expensive. They don't need to be time consuming or complicated. Schmoozing at the kiddish with friends, going to a barbecue, spending time with family, or getting ice cream. This is just a reminder to make the most of those things and to do more of them to increase your level of happiness. Anyway, one quick note today before I get started, which is my upcoming fall live webinars will start on September 4th at 8:30 a.m., like I've been saying each episode for the past few weeks. And the first one that I'm having on September 4th is on tax issues with distressed real estate, featuring Matthew E. Rappaport of Falcon Rappaport and Berkman, based in Long Island, New York. And I'll be sure to include the registration information in the show notes of this episode. And I imagine this topic will be incredibly timely given where we are in the economy and in the real estate cycle. Okay, now for today's agenda. My talking points this week will discuss how to manage a financial windfall. Our quote this week is from Johnny Depp on paying for privacy and what that means. I'll spend the last half of the episode answering listener questions, including sports betting as an investment. And finally, we're going to end with an actionable idea to implement your investing life. We'll discuss the folly over fighting over inheritance. And with that, let's jump into this week's talking points. So, following Tisha B'Av, which we just observed not too long ago, we begin a series of seven Haftorot of consolation, Shiva de Nechemta, as they're called, leading up to Rosh Hashanah. These readings, all from the book of Isaiah, offer messages of redemption and divine reassurance after the sorrow of the 3 weeks and Tisha B'Av. And this past weekend, Shabbos Nachamu, in particular, marks a spiritual turning point from mourning to comfort. In the financial world, few things offer more comfort than receiving a large sum of cash. The challenge is how to handle a windfall responsibly based on the markets, economic environment, and personal circumstances. I'm going to offer a framework that may be helpful to ensure that your large inflow of capital, irrespective of whether from selling a business, a large gift, a life insurance settlement, bonus, or inheritance, is being handled responsibly. First, pay off debt. An important first step after receiving a large windfall is to assess your overall finances. If you've borrowed any money, you should consider paying that off first. It's very difficult to grow your wealth while you have an onerous level of debt weighing you down. Credit card debt, student loans, and auto loans are all bad and should be paid off as soon as possible. Conversely, a low rate fixed mortgage on your primary residence and some form of business debt can be paid off more slowly. Once you relieve yourself of your burdensome debt, you can explore the best way to invest this capital. The next thing to consider is to do not time the market. Since the market is around all-time highs as of this recording, some investors may consider the idea of waiting for the bottom of the next bear market to invest their money. On the surface, waiting for stocks to drop by 20% in order to buy things on the cheap seems like a great idea. In practice, this strategy is impossible. There's no way to perfectly time the market, even if the market did fortuitously free fall just before you had a large pool of capital to invest. Most people would still hesitate to start investing. Their psyche would tell them that the market can always fall further. Furthermore, markets tend to rise 3 out of every 4 years. Even though the market is currently at a high, it has a probability of continuing to rise going forward. So there is no need to be concerned about investing at a market high. The next point, and one that I just mentioned earlier, is that diversification is a must. Choosing to have exposure to a variety of different investments is always imperative. While the US market has been setting record highs, it also has experienced large periods of underperformance. Additionally, while most global markets have not had such a good run over the past decade or so, they have outperformed the US this year. The same is true for various asset classes and sectors whose performance moves in cycles. Maintaining a diversified strategy when deploying capital can minimize volatility, risk, and offer a higher probability of achieving your financial goals. Investors should always pursue a strategy of diversification across geographies and asset classes. Next is to understand your time horizon. The most important factor in managing money is understanding the time horizon for when money will be needed. It sounds basic, but very often this concept is overlooked. Determine your investment strategy with the end in mind. If you need your money in the near term to make a down payment on a house, then investing in venture capital or growth stocks should be avoided. Sticking to something safer like a money market account or short term bonds. On the other hand, if you have a multi-decade time horizon, you may wish to invest a portion of your portfolio in volatile small capitalization growth stocks that may appreciate significantly over time. Investors' liquidity requirements are essential to determine any investment strategy. Next, you should evaluate this sum of money in relation to its percentage of your net worth. Objectively, the amount of new money to invest may be large or feel large, but it's important to consider its size relative to your total savings. For example, inheriting $500,000 when you already have $2 million saved for retirement comes with different considerations than if you only had $250,000 saved. If the figure is less than 25% of your investable assets, then it may make sense to invest it all at once after paying off your expenses, obviously, in a similar allocation to your current portfolio. If it's a relatively small sum of money, stressing over when to invest it won't necessarily change your current or future lifestyle. If these funds are more than 25% of your nest egg, then you should consider whether it makes sense to invest the lump sum or dollar cost average over time. Which brings me to my next point, which is should you invest in the lump sum or dollar cost average? And deciding whether to invest the lump sum at once or spreading it out over time relates back to time horizon and not trying to time the market. Since the market's long term trend is positive, mathematically, the best course of action for an investor with a multi decade time horizon whose specific risk tolerance doesn't indicate otherwise may be to invest the entire lump sum immediately. This will allow them to buy at lower average prices, which may allow them to outperform a strategy of slowly adding money over time. Psychology, I should say, is also a factor in the decision. Folks who are nervous about the market and can't stomach adding a substantial level of funds all at once may be better off setting up a systematic approach to add money to their portfolio at predetermined intervals. Dollar cost averaging allows investors to get their money invested over time without letting their emotions derail their finances. While this approach may not lead to the best investment performance relative to lump sum investing, having peace of mind is also an important consideration. Another consideration on handling these funds is whether you're approaching retirement. Folks who are retired or who will be retiring shortly need to be the most careful with their investment strategy on new inflow of assets. Investing a large sum of money right before you stop working and then experiencing a major market downturn can be devastating. This sequence of returns risk, or the risk of experiencing a string of unfavorable returns as you begin to draw down your portfolio, is a very difficult scenario from which to recover. A good example of this was during the 2008-2009 Great Financial Crisis. Some soon-to-be retirees had their 401k invested much too aggressively or too concentrated in their own company stock. The market downturn and fragility of the financial system was devastating. Instead of retiring as planned, some of these people got wiped out by the market crash and were forced to remain working for much longer. One way to invest that manages for sequence of returns risk is to set up a bond tent. This strategy keeps a few years worth of expense money in very short term, high quality bonds or cash. The remaining assets can be invested in the market, perhaps more aggressively according to the individual's various other goals. Should the market have several years of subpar returns, the investor won't have to liquidate their more volatile holdings like stocks at a steep loss. Rather, they'll be able to use their cash cushion of high quality bonds to meet their expenses as they wait for the market to recover. Next is what people may think about. Next thing that people may think about is this situation, which is to keep for yourself or should you give some to others? The desire to give is embedded in most Jews, with tzedakah and helping out children being part of our genetic makeup. The question is, how much of this windfall should be used for your own benefit and how much should be given up to help others? If the funds came from inheritance, sale of a business, sale of real estate, or a bonus, then I'd recommend giving immediately off the top 10% of the net proceeds to tzedakah right and you get it. It's a mitzvah and a core part of our being. However, funds that come from a 401k roll over into a new plan or into your IRA should not be taken out before a certain age to avoid being subject to unnecessary taxes and penalties. Since 401k funds were already part of your assets and not a new source of income, no additional maser needs to be taken from them. As for helping out family members, remember the concept of pay yourself first. This simply refers to the fact that failure to make yourself a priority in this regard can lead to a challenging financial consequences in the future. Once you have taken the steps to ensure that your financial well being is all secure, it is up to you how much you want to give to your children to assist them in their own finances. And finally, I'll end with this. When it comes to receiving a large financial windfall, please don't do nothing. Indecision has a price. Don't sit paralyzed in cash while contemplating your next move. That paralysis will have the negative consequences of losing buying power with inflation and missing out on compound interest. It may lead to other unfavorable ramifications of not taking a proactive approach to your finances. Remember, if your financial windfall was tied to a business or to real estate, there was already risk associated with its capital. The fact that the proceeds can now be diversified among a variety of different asset classes is a wonderful opportunity that should be seized. Receiving a large windfall is a blessing, but the stresses associated with how to manage these funds properly can feel overwhelming. Take the opportunity to touch base with your tax, legal, and financial advisors to get their advice on your updated financial situation. It's also a good time to revisit your overall strategy and possibly update your investment policy statement. Speaking to your trusted advisors to develop a sensible approach can remove the decision making stress and ensure that your funds are a source of comfort and simcha for you and your family. Okay, those are the talking points this week. And as a reminder, you can be notified of all my recent articles, webinars, and all the other work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Johnny Depp. For those who don't know, Johnny Depp is an American actor and musician renowned for his eclectic roles and unconventional career choices. He began as a rock musician before transitioning to acting, making his film debut in A Nightmare on Elm Street, which I didn't actually know that until I did my own due diligence. Depp rose to fame in the late 1980s with TV series 21 Jump Street and later became a Hollywood icon through his portrayal of Captain Jack Sparrow in the Pirates of the Caribbean franchise. Depp once said, "You use your money to buy privacy because during most of your life you aren't allowed to be normal." This quote highlights the challenges faced by many public figures, particularly those in the entertainment industry, in maintaining a degree of normalcy in their lives. For individuals like Johnny Depp, constant public scrutiny and media attention can make simple everyday activities a challenge. The quote suggests that for some celebrities, the financial resources they acquire through their work are then used in part to create a buffer against the constant intrusion of the public eye and to regain some semblance of normal private existence. In essence, the quote emphasizes the trade off that can exist between fame, wealth, and the ability to live a private life free from constant public observation. So many regular people believe that once you have amassed a certain threshold of wealth or fame, that will be the answer to all their problems. Meanwhile, the folks with lots of wealth and fame spent a tremendous amount of money just trying to fly under the radar and keep their privacy. Be careful for what you wish for, and be thankful for the anonymity you have. There are many people who spend millions of dollars, literally, as we see, every year for what you have for free. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. First question. Given Trump's obsession with tariffs and the market's recent plunge, do you think the market will recover and how long will it take? The market's still about near all-time highs, but yes, it's going to recover even when it dips. However, no one has any idea how long it will take. Ultimately, there will either be agreements with other countries, which we've seen a little bit of, to have more balanced trade policy, or one that is deemed acceptable by both parties. Alternatively, companies will adapt and figure out a way to structure their business in a high tariff environment. Finally, Trump is gone in 2028, so if the market continues to be schwach, the new administration will change policy and the market will rebound. Regardless of what scenario you choose, the market will end up rebounding. Unfortunately, there are many investors who will not recover. These include folks with concentrated investments who refuse to diversify. Others will be traumatized by this experience and stay in cash to their own detriment. I once spoke to a dude who had $9 million sitting in cash, and I've told this story before, but it's worth repeating. And he's been sitting in cash with those $9 million since 2009 when he liquidated his portfolio at a low point and he couldn't get back into the market, which was too bad for him and his family. The bottom line is this: if you have a sensibly structured portfolio and have no need for these funds in the near to medium term, you should stay the course and you will be fine. The next question is: I'm 67 years old and want to buy my dream home in a new development just outside of Jerusalem. The sticking point is it's about 40% of my total liquid net worth. Should I do it or not? I do know the cost of living in Israel is cheaper, so perhaps that factors in. Buying this apartment, given your situation which you just laid out, sounds like a terrible idea. Wiping out your nest egg for a development that will take years to build and will certainly cost more than the list price is silly. You spent your lifetime accumulating a nest egg. I don't believe your dream included using most of that money for a new development that will cause nothing but stress and financial strain in your life. You should enjoy living the dream in Israel in your rented apartment. You'll be able to sleep soundly knowing you don't need to sweat your finances. Next questions. I'm 65 years old and inherited $650,000. My question is if I'm too old to invest in the stock market, kind of related to what we spoke about in my talking points. No. In fact, in today's world, with people living much longer, it is prudent to have a chunk of your money invested in the stock market to outpace inflation and maintain your buying power. You may also have higher healthcare costs as you age, so growing your wealth is sensible. Finally, many people have legacy goals where they want to leave money to their kids, grandkids, and charities. In all these scenarios, one must invest in stocks to achieve their goals. I don't have a full picture of your finances, but a healthy weighting towards stocks at the start of your retirement is almost always a good decision. Just be sure to mitigate the risk of market downturn by utilizing a bond tent, structuring a form of guaranteed payment, or the like. Staying in a money market account, CDs, and cash is the real risk for folks in your situation, as they dramatically increase the probability of outliving their funds. Okay, the next question is: what are your thoughts or slash forecasts on commercial real estate as an asset class? So commercial real estate is necessary and a big part of the real estate market. Even though it is sensible in today's world for many people to work at home, where they are more productive and happier, there's still plenty of jobs that require being in person. Like lawyers who are clinging to a world of suits, ties, and living in an office where you're only permitted to emerge once you've reached 120 hours of billing time for the week. Perhaps it's not every day or all employees, but showing up in person has its place in some industries. Given this new reality, landlords need to reposition their real estate to cater to this new environment. This may mean more cubicles or a system where most employees don't have a designated office and are assigned one once they get into the office. There also needs to be a space for team building activities so you can really bond with your coworkers. I'm just joking about that. Like all serious companies, they need a space for scavenger hunts, escape rooms, office trivia, playing two truths and a lie, and having discussions about your weekend and the local weather patterns. If there's no space where grown adults can play games with each other instead of working or spending time with their family, then I question the landlord's strategy. My forecast on commercial real estate is cautiously optimistic, assuming landlords take proactive steps to make their space more desirable. I'd sooner get my real estate exposure through a broadly diversified, publicly traded REIT fund, real estate investment trust, for those who don't know the acronym. But some investors like to get their kicks through physical properties, and kol hakavod to them. Next question: where does sports betting fit into my investment strategy? It's a fast growing area, so I just want to be on top of this trend. It doesn't fit in. Sports betting is a hobby, it's not an investment. You'll certainly lose money, and I see that Robinhood has already rolled out sports gambling, so you know it's not meant for serious investors. Soon enough, Larry Fink, the world's biggest bookie from BlackRock, the world's largest casino, although they also have some very good real investment products, will jump into the pool and fool even more people into thinking that it's a real investment strategy, even though it isn't one. Here's a good rule of thumb: anything that is super exciting and gets your juices flowing is probably speculating and not a prudent investment. Steer clear of nourishkeit, and you will increase your probability of being able to achieve your financial goals. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me, and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I like to end with a timely and actionable idea that listeners can implement to their own financial lives. Today's timely idea is to try to avoid family infighting over inheritance. I want to say first that this is not always preventable. Sometimes a family member does something so egregious that it requires a response and possibly even legal action. However, keep in mind that sometimes it's worth swallowing your pride, getting screwed, taking less money, and just moving on with your life. I don't say this lightly. On numerous occasions, I've seen families ripped apart over inheritance and disputes. Beyond your family getting torn apart, think about yourself and other family members, like your spouse and your young children or grandchildren. Getting mired in a multi year legal battle will cost you a tremendous amount of money, which will seriously erode your family's wealth. And more importantly, it'll take years off your life. Literally years. You don't want this type of family litigation to occupy your headspace for years. It will have an adverse ripple effect on all aspects of your life. Sometimes the best decision is to quickly work out a resolution where you are seemingly sacrificing more for the ability to move on with your life. Yes, it's frustrating, but your life will usually be better because of it. Trust me. The only winner in these family financial disputes are the attorneys who will collect six and sometimes seven figures in legal fees. Planning ahead may help avoid these issues. That's why the patriarch and matriarch of the family should consult a competent estate planning attorney who also understands the human elements of planning and the family dynamics at play. Also, being vocal and communicative of your desires to your children is helpful. Nothing will minimize the risk completely. We live in America, the land of litigation and the endless appeal system. However, planning and vocalizing your desires is very helpful. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.